This presentation is for Accounting 221, Accounting Principles 1, Chapter 6, Merchandise Inventory. These are the first three learning objectives for Chapter 6 to identify accounting principles and controls related to merchandise inventory, account for merchandise inventory cost under a perpetual inventory system, and to compare the effects on the financial statements when using the different inventory costing methods. The next three learning objectives are to apply the lower of cost or market rule to merchandise inventory, to measure the effects of merchandise inventory errors on the financial statements, and to use the inventory turnover and days sales in inventory to evaluate business performance. The last learning objective is to account for merchandise inventory cost under a periodic inventory system. In the first section, we will identify accounting principles and controls related to merchandise inventory. There are several principles on which the foundations of accrual accounting are built. Some of these principles are consistency, full disclosure, materiality, and accounting conservatism. These principles are discussed in this presentation. The consistency principle states that a business should use the same accounting methods and procedures from period to period. Consistency helps investors and creditors compare a company's financial statements from one period to the next. Companies must be consistent in the accounting methods they use. If changes are made in accounting methods, the company should communicate the changes to the stakeholders. The disclosure principle states that a business's financial statements must report enough information for outsiders to make knowledgeable decisions about the company. The materiality concept states that a company must perform strictly proper accounting only for items that are significant to the business's financial situation. In essence, the materiality concept recognizes that the size of the dollar amounts in transactions is most relevant when compared to the overall size of the company. For example, a $10,000 transaction is very relevant to a $100,000 company. However, to a $1 billion company, a $10,000 transaction is probably not large enough to, of itself, impact the decision of a stockholder or creditor. The conservatism principle states that a business should report the least favorable figures in the financial statements when two or more possible options are presented. Basically, conservatism is choosing the accounting treatment that is least likely to overstate assets or net income. Maintaining good controls over merchandise inventory is very important for a merchandiser. Good controls ensure that inventory purchases and sales are properly authorized and accounted for by the accounting system. This can be accomplished by taking the following measures. The company should ensure that merchandise inventory is not purchased without proper authorization, including purchasing only from approved vendors and within acceptable dollar ranges. After inventory is purchased, the order should be tracked and properly documented when received. At the time of delivery, a count of inventory received should be completed and each item should be examined for damage. Damaged inventory should be properly recorded and then should either be used, disposed of, or returned to the vendor. A physical count of inventory should be completed at least once a year to track inventory shrinkage due to theft, damage, and errors. When sales are made, the inventory sold should be properly recorded and removed from the inventory count. This will prevent the company from running out of inventory, often called a stock out. In the second section, we will account for merchandise inventory cost under a perpetual inventory system. At the end of each fiscal period, two accounts reflect information about inventory, merchandise inventory, and cost of goods sold. The number of units in merchandise inventory at the end of the period can be determined by physically counting the amount of inventory owned by the company at the end of the period. The number of units sold during the period will be determined and then multiplied by the per unit cost of the inventory. When the cost of the inventory does not change during the month, the assignment of dollar amounts to ending inventory and to cost of goods sold becomes fairly easy exercise. Simply multiply the number of units on hand by the cost per unit. Likewise, multiply the number of units sold by the cost per unit. When the cost of acquiring inventory changes during the period, it becomes more unclear how much cost should be applied to each unit in ending inventory. Basically, there are four approaches that are acceptable according to GAAP for computing the amount of dollars to assign to ending inventory and to cost of goods sold. An inventory costing method is a method of approximating the flow of inventory cost in a business that is used to determine the amount of cost of goods sold and ending merchandise inventory. The costing methods are specific identification, first in, first out, or FIFO, last in, first out, or LIFO, and weighted average. The specific identification method is an inventory costing method based on the specific cost of particular units of inventory. The specific identification method is dependent on being able to identify the specific cost associated with each individual item in inventory. This is most efficient when each item in inventory is unique with a unique identifier. Examples include automobiles that have a unique vehicle identification number, real estate identified by address, and jewels such as a specific diamond ring. Assume that of the 4 tablets sold on August 15th, 1 had a cost of $350 and 3 had a cost of $360. As for the August 31st sale, 1 had a cost of $350 and 9 had a cost of $380. The cost of goods sold and ending merchandise inventory are shown in Exhibit 6.3. In effect, each time there is a sale, we would remove from inventory only the cost that is specifically identified with the specific units that are sold. This method requires the business to keep detailed records of inventory sales and purchases and to also be able to carefully identify the inventory that is sold. The first in, first out, or FIFO method is an inventory costing method in which the first cost into inventory or the first cost out to cost of goods sold. Ending inventory is based on the cost of the most recent purchases. When using perpetual FIFO, we account for each purchase and sale as it happens. When we sell items, we are usually unable to identify which specific items we have sold, since they are all homogeneous. For accounting purposes, we will assume that the units sold were the oldest units in inventory at the time of the sale. We will remove the oldest units along with their cost from the inventory record, leaving the newest units available and as part of ending merchandise inventory. Smart Touch Learning began August with 2 tablets that cost $350 per unit. On August 5th, an additional 4 units were purchased for $360 each. The company now has 6 units on hand. On August 15th, the company sold 4 units. Under FIFO, the first 2 units sold had the oldest cost from beginning inventory of $350 per unit. The other 2 units will be assigned from the August 5th purchase of $360. That leaves 4 units in inventory on August 15th at $360 each. On August 26th, Smart Touch Learning purchases 12 units of inventory at a cost of $380 per unit. The sale on August 31 indicates 10 units were sold. Because the oldest units in inventory at this time are the 2 units remaining from the August 5th purchase, they will be assigned to the sale first. The remaining 8 units will come from the August 26th purchase, leaving 4 units at $380 per unit in ending inventory. For the journal entries on this slide, assume all purchases and sales of inventory are on account. The amounts unique to FIFO are shown in blue for emphasis. All other amounts are the same for all 4 inventory methods. On August 5th, Smart Touch Learning purchased $1,440 of inventory and made the first journal entry. On August 15th, the company sold 4 tablets for the sales price of $500 each. Smart Touch Learning recorded the sale, $2,000, and the cost of goods sold, $1,420, calculated in Exhibit 6.4 as 2 units at $350 plus 2 units at $360. The remaining journal entries for August 26th and 31st follow the inventory data in Exhibit 6.4. The last in, first out method is an inventory costing method in which the last cost into inventory are the first cost out to cost of goods sold. The method leaves the oldest costs, those of beginning inventory and the earliest purchases of the period, in ending inventory. When we sell items, we are usually unable to identify which specific items we have sold, since they are all homogeneous. For accounting purposes, we will assume that the units sold were the newest units in inventory at the time of the sale. We will remove the newest units along with their cost from the inventory record, leaving the oldest units available to be assigned to the next sale. Again, Smart Touch Learning had 2 tablets at the beginning. After the purchases on August 5th, the company holds 6 units of inventory, 2 units at $350 plus 4 units at $360. On August 15th, Smart Touch Learning sells 4 units. Under LIFO, we assign all 4 units from the August 5th purchase, along with their costs, to the sale. The remaining 2 units in inventory are from the beginning inventory and are available, if needed, to be assigned to the next sale. On August 26, Smart Touch Learning purchases 12 units of inventory at a cost of $380 per unit. The sale on August 31 indicates 10 units were sold. Since the newest units in inventory at this time are the 12 units remaining from the August 26 purchase, they will be assigned to the sale first. The remaining 2 units from the August 26 purchase at $380 per unit will be added to the 2 units from the beginning inventory at $350 and will comprise ending inventory for the period. For the journal entries on this slide, assume all purchases and sales of inventory are on account. The amounts unique to LIFO are shown in blue for emphasis. On August 5th, Smart Touch Learning purchased inventory of $1,440. The August 15th sale brought in sales revenue, 4 units at $500, of $2,000, and cost of goods sold, 4 units at $360 is equal to $1,440. The August 26th and 31st entries also come from the data in Exhibit 6.5. The weighted average method is an inventory costing method based on the weighted average cost per unit of inventory that is calculated after each purchase. Weighted average cost per unit is determined by dividing the cost of goods available for sale by the number of units available. When units are sold, they are removed from inventory using the weighted average cost at the time of the sale. When new purchases are added, the weighted average cost per unit will change again and will become the new weighted average cost that will be used for the next sale. In our example, the weighted average cost on August 1st is $350 per unit, calculated as $700 divided by 2 units. When 4 units are purchased on August 5th at $360 per unit, $1,440 is added to inventory and 4 units are added. There is now $2,140 in inventory and 6 units, leaving a weighted average cost per unit of $356.67 per unit. On August 15th, 4 units are sold. For purposes of removing items from inventory, we will cost those sold units at the current weighted average cost per unit, or $356.67 per unit. This will remove $1,427 from inventory, $356.67 times 4, leaving $713 in inventory. The remaining 2 units are valued at the weighted average cost of $356.67 per unit. When we add 12 units at $380 each on August 26, there will now be $5,273 in inventory and 14 units. The new weighted average cost per unit will be $376.64, which will result in ending inventory having a total cost of $1,507. After each purchase, Smart Touch Learning computes a new weighted average cost per unit. For example, on August 5th, the new weighted average is $356.67 per unit. While the weighted average cost method, with the weighted average cost method, rounding errors can occur. However, this is not the case in this example. Notice that cost of goods sold and ending inventory total $6,700, which is $5,193 plus $1,507, and that equals the total cost of goods available for sale. For the journal entries on this slide, assume all purchases and sales of inventory are on account. The amounts unique to the weighted average method are shown in blue for emphasis. On August 5th, Smart Touch Learning purchased $1,440 of inventory and made the first journal entry. On August 15th, Smart Touch Learning sold 4 tablets for $500 each. The company recorded the sale, $2,000, and the cost of goods sold, 4 units at $356.67, or $1,427. The remaining journal entries, August 26th and 31st, follow the same procedure. In the third section, we will compare the effects on the financial statements when using the different inventory costing methods. What leads Smart Touch Learning to select the specific identification, FIFO, LIFO, or weighted average inventory costing method? The different methods have different benefits. Many companies prefer high income in order to attract investors and borrow on favorable terms. FIFO offers this benefit in a period of rising costs. Lower profits mean lower taxable income. Thus, LIFO lets companies pay the lowest income taxes when inventory costs are rising. Therefore, companies that seek a middle ground solution use the weighted average method for inventory. Exhibit 6.7 summarizes the result for the 4 inventory costing methods for Smart Touch Learning. It shows revenue, cost of goods sold, and gross profit for specific identification, FIFO, LIFO, and weighted average. First, we see FIFO produces a lower cost of goods sold and a higher gross profit than either LIFO or weighted average. Also, we see that LIFO provides a higher cost of goods sold and a lower gross profit than FIFO or weighted average. Weighted average provides a cost of goods sold and a gross profit that is between LIFO and FIFO. Exhibit 6.8 shows the results of Smart Touch Learning's ending merchandise inventory for each of the costing methods for August. Notice that when using the FIFO inventory costing method, ending merchandise inventory will be the highest when costs are increasing. LIFO produces the lowest ending merchandise inventory, and weighted average is again in the middle. Exhibit 6.9 summarizes the effects on the financial statements during periods of rising and declining inventory cost. The relationship that we observe with our inventory example will be true anytime that costs are constantly increasing. When prices are constantly decreasing, the relationship will be just the opposite. In the fourth section, we will learn how to apply the lower of cost or market rule to merchandise inventory. Even after we have used one of the inventory methods to determine the cost of the ending inventory and cost of goods sold, there is a limiting rule in accounting called the lower of cost or market rule. Under the lower of cost or market rule, the final carrying amount of the inventory on the books will be the lower of the cost as determined using one of the inventory methods, or the market value of the inventory. In some cases, inventory will decrease permanently in value while it is being held by the company. For example, a new product may be introduced by a competitor that makes all existing inventories obsolete. In such cases, the market value of the inventory on hand may actually be lower than its original cost. In those cases, we will adjust inventory to the lower amount. Let's assume that Smart Touch Learning paid $3,000 for inventory. By December 31, that inventory is worth only $2,200, and the decline in value appears permanent. We will adjust the $3,000 debit balance in inventory by crediting it for $800, bringing the balance to $2,200. The debit for the adjustment will be to cost of goods sold. Companies often disclose that the lower of cost or market rule is followed in notes to their financial statements. In the fifth section, we will learn how to measure the effects of merchandise inventory errors on the financial statements. It is crucial that the ending inventory amount on the balance sheet be correct. If it is incorrect, it will have a domino effect on several other numbers, such as cost of goods sold, gross profit, and net income. To illustrate an inventory error, assume Smart Touch Learning accidentally reported $5,000 more merchandise inventory than it actually had. In that case, ending merchandise inventory would be overstated by $5,000 on the balance sheet. As such, cost of goods sold is understated and gross profit and net income are both overstated. Understating the ending inventory, reporting the inventory too low, has the opposite effect of an overstatement. If Smart Touch Learning's inventory is understated by $1,200, the cost of goods sold would be overstated. As such, the gross profit and net income would be understated. Recall that one period's ending merchandise inventory becomes the next period's beginning inventory. As a result, an error in ending merchandise inventory carries over into the next period. Exhibit 610 illustrates the effect of an inventory error, assuming all other items on the income statement are unchanged for the three periods. Period's 1 ending merchandise inventory is overstated by $5,000. Period 1's ending merchandise inventory should be $10,000. The error carries over to period 2. Period 3 is incorrect. In fact, both period 1 and period 2 should look like period 3. Ending merchandise inventory is subtracted to compute cost of goods sold in one period, and the same amount is added as beginning merchandise inventory in the next period. Therefore, an inventory error cancels out after two periods. The overstatement of cost of goods sold in period 2 counterbalances the understatement for period 1. Thus, total gross profit for the two periods combined is correct. The effects of inventory errors are summarized in Exhibit 611. In the sixth section, we will use the inventory turnover and days sales in inventory to evaluate business performance. Companies try to manage their inventory levels such that they will have just enough inventory to meet customer demand without investing large amounts of money in inventory sitting on the shelves gathering dust. The inventory turnover ratio measures the number of times a company sells its average level of merchandise inventory during a period. Inventory turnover is equal to cost of goods sold divided by average merchandise inventory. A high rate of turnover indicates ease in selling inventory. A low rate indicates difficulty. The days sales in inventory measures the average number of days that inventory is held by a company. Days sales in inventory equals 365 days divided by inventory turnover. A lower days sales in inventory is preferable because it indicates the company is able to sell its inventory quickly, thereby reducing its inventory storage and insurance costs, as well as reducing the risk of holding obsolete inventory. Let's return to Kohl's Corporation and evaluate the company's inventory levels using the two ratios discussed. It appears that Kohl's sells its average inventory 3.12 times per year. A high turnover rate is desirable, and an increase in the turnover rate usually means higher profits. The days sales in inventory of Kohl's indicates that the company on average takes 117 days to sell inventory. This seems a little high for a retail store, but it should be evaluated against the industry average. In the last section, we will study how to account for merchandise inventory cost under a periodic inventory system. An alternative to accounting for inventory using a perpetual approach is to account for the inventory using a periodic approach. Under the periodic approach, the tedious task of recording each sale as it impacts cost of goods sold and the inventory account is eliminated. Essentially, we will start the month with the balance in beginning inventory. As we acquire additional inventory, we record that inventory in a purchases account. When we sell inventory, we do not record an adjustment to the inventory or cost of goods sold account. Rather, we only record the sale and its impact on cash or accounts receivable. We will start with the information in the accounting records regarding the flow of inventory during the period. We can see from the inventory record that we started the month with 2 units in inventory. We purchased more inventory on August 5th, 4 units, and on August 26th, 12 units, for a total of 16 units purchased during the month. Combined with the beginning inventory of 2 units, there are 18 units available for sale during the month. We sold inventory on August 15th, 4 units, and on August 31st, 10 units, for a total of 14 units sold during the month. Once we know this information, we can compute ending inventory using one of our 3 methods. With FIFO, we assume that the oldest units in inventory will be sold first, so we take those out of inventory before taking any other units out of inventory. We assume the ending inventory is comprised of the newest units in inventory. In our example, the beginning inventory of 2 units at $350, $700, plus the net purchases for the period, $6,000, will give us $6,700 of inventory available for sale during the month. We know that we have 4 units left in ending inventory, and those units will represent the 4 most recently purchased units. The 4 most recently purchased units were purchased at a cost of $380 per unit, giving us an ending inventory of $1,520. The cost of goods sold is determined by subtracting the ending inventory of $1,520 from the cost of goods available for sale, $6,700, to arrive at cost of goods sold for the period of $5,180. Or the cost of goods sold can be calculated by taking the 2 units from beginning inventory at $350 plus 4 units at $360 and 8 units at $380 for a total again of $5,180. With LIFO, we assume that the newest units in inventory will be sold first. We assume that the ending inventory is comprised of the oldest units in inventory. In our example, the beginning inventory of 2 units at $350 plus the net purchases for the period, $6,000, will give us $6,700 of inventory available for sale during the month. We know that we have 4 units left in ending inventory, and those units will represent the 4 oldest units. The 4 oldest units will be comprised of the 2 units from beginning inventory, 2 times $350 or $700, plus 2 of the units from the August 5th purchase, 2 units times $360 or $720, giving us an ending inventory of $1,420. The cost of goods sold is determined by subtracting the ending inventory of $1,420 from the cost of goods available for sale, $6,700, to arrive at cost of goods sold for the period of $5,280. Or the cost of goods sold can be found by taking the 12 units at $380 from the August 26th purchase, plus 2 units at $360 from the August 4th purchase, for a total again of $5,280. With the periodic weighted average method, the order of the sale is irrelevant. All inventory will be removed from inventory using the average cost of the inventory for the period. The first step is to determine the weighted average cost per unit of inventory. The weighted average cost per unit is determined by the following formula: cost of goods available for sale during the period divided by number of units available for sale during the period. So $6,700 divided by 18 units is equal to $372.22 per unit. To estimate the cost of ending inventory, we multiply the weighted average cost per unit by the number of units in ending inventory, or $372.22 times 4, which is equal to $1,489. The cost of goods sold is determined by subtracting the ending inventory, $1,489, from the cost of goods available for sale, $6,700, to arrive at cost of goods sold for the period of $5,211. This is the conclusion of the presentation on Chapter